I hope everybody stays safe during these trying times. There are quite a few lessons we can learn from this experience, including quant lessons. In particular, one aspect that seems worth analysis is why do so many quant firms struggle during the COVID-19 related sell-off? In particular, market neutral strategies, equity market neutral strategies. These funds are supposed to deliver uncorrelated returns, and yet there are many of them that have experienced substantial losses, perhaps as much as half of the losses of the market. This is not something that has occurred to all quant firms. In particular, market making firms have experienced above average profits during the month of March. So why is it that we have, on one hand, funds that are supposed to deliver uncorrelated returns struggling, and other funds that are very sensitive to trends that have profited during a very strong sell-off? So we're going to discuss this puzzle over the next few minutes. And in particular, I'm going to mention 3 lessons that I think are worth considering from this crisis. The first lesson is related to nowcasting and forecasting. Forecasting is very common among quantitative firms. The idea is we can use structured data to make long-range predictions. And with long-range, what I mean is predictions that involve multiple days ahead or weeks, months ahead. Traditionally, these predictions are based on models that either model the time dynamics of time series. For instance, the strategies promoted by startup firms or CTAs. And on the other hand, modeling patterns cross-sectionally, like asset pricing firms or factor investing firms do. So we have these 2 flavors of forecasting. What is common of these 2 approaches to forecasting is that both of them rely on lag data, and they are trying to identify historical patterns in order to make a prediction. Now, there are 2 caveats as it relates to this approach to forecasting. Number 1 is these relationships do not always hold. Correlations are anything but stable. And number 2, forecasting made a lot of sense decades ago when we had very limited data, and data that came delayed and was noisy, and there were very few different variables that we could take into account in our analysis. Today, fortunately, we have an abundance of various variables that we can estimate almost in real time. And that's the idea behind nowcasting. Can we use unstructured data, not structured, but unstructured data from sensors and various variables that are produced by different market agents and agents in the economy, in order to do 2 things. Number 1, direct measurements. For instance, can we evaluate inflation in real time? Not forecast inflation, but measure inflation in real time. So what is the difference? If we were to forecast inflation, we would be looking at various variables that we believe impact inflation, like wages, and unemployment, excess capacity, inventories. So that would be one way, the traditional way, econometrics forecasts inflation. Instead of that, how about we measure directly price changes? There are very few assumptions involved in direct measurements. And number 2, nowcasting sometimes also involves short-range predictions. For instance, we could try to estimate earnings of a retailer based on parking lot occupancy, where we are using, again, unstructured data That's an important characteristic of nowcasting. The advantages that nowcasting has over forecasting is that, number one, direct measurements hold true. If we estimate inflation directly, there are very few assumptions involved in that estimate. Number two, short-range predictions tend to be statistically more reliable than long-range predictions. So if we are trying to estimate earnings based on parking lot occupancy, that the assumptions involved are much less than if we are trying to estimate earnings using past earnings or the time series dynamics of earnings. In both cases, nowcasting always involves millions of recent observations. So it is not a forecast, or is not an estimate based on a few data points. Is based on a large number of independent or quasi-independent observations. A very nice example of nowcasting, it comes from the Billion Prize project, where researchers collect millions, tens of millions of prices from websites in order to estimate inflation in real time for almost 100 countries. Now, nowcasting, it is not something embedded in finance. In fact, nowcasting is very common across various scientific fields. Think, for instance, the challenge involved in forecasting earthquakes. They are not forecastable. We don't know exactly when or where the next major earthquake will hit. But what we can do is we can analyze data as soon as is captured and produced in order to produce an early warning. So we may not be able to avoid the earthquake, but we can warn people in order to minimize the loss of life and even damages. Even a few seconds warning can make all the difference. And today, various states offer various applications that warn citizens seconds before an earthquake strikes their area. So once an earthquake is detected, we can warn the cities that are impacted, and also we can model what are the areas, the coastal areas that are going to be impacted by tsunamis. In this chart, what you can see is that once the Sumatra earthquake occurred on December 26, 2004, there were several hours of warning until the tsunami reached various coastal areas. So for instance, Australia received a 5 hours warning. Again, the purpose of this methodology is not to forecast when a tsunami will occur. It's once the earthquake occurs, what areas may be affected by a tsunami. The same approach can be applied to finance. Rather than applying various mathematical methods for essentially guessing, what we could do is apply mathematical methods to produce early warning systems. And we may be affected by part of the initial impact, but we may avoid much of the most dramatic and draconian effects of for instance, the sell-off related to COVID-19. There are several examples of nowcasting in finance. For instance, inflation estimates, web scraping millions of online prices happens to be much more accurate than convoluted econometric models. Number two, evaluation of liquidity conditions. Based on millions of daily fixed messages, we can anticipate when there is panic-like behavior, when there are informed traders, when there is a massive change in flows. And again, the purpose is not to predict panic, is to observe panic. And once the panic unfolds, to adapt accordingly. Earnings retailers can be analyzed based on various indicators of increased consumption and activity around shops using satellite images or email receipts, credit card transactions, etc. And industrial production is another variable that can be evaluated using engineering data sets, for instance, from exploration and production companies, cargo shipments, auto production numbers, electricity consumptions, images from satellites on the night sky. In this plot, you can see an example where measurable AI detected that Best Buy was enjoying greater sales during the 2009 holiday season and outpacing Target. Those individuals who use NowCasting had an early warning that Best Buy would do better months before both companies file the regulatory disclosures. Was COVID-19 a black swan? Well, probably not. Number one, pandemics are very common. They occur on a recurrent basis. Just in the 20th century, we had 5 flu-related pandemics, but there are pandemics not related to other conditions than the flu. So definitely we need to have metrics and methods to evaluate when the next flu-related pandemic or any other pandemic occurs. In the particular case of COVID-19, there were plenty of warning signs prior to the market sell-off. There were indications that there was a disruption in the supply chain coming from China, and commodities were also affected, as you can see in the plot here on the right. So COVID-19 may have been a black swan to people utilizing forecasting methods, but it's definitely not a black swan if you are analyzing data in real time and you observe how flows are being liquidated. And with that, we would like to open the floor for a quick poll where we're going to ask a question and analyze your feedback. So the question is, for price prediction or risk management, does your company rely primarily on forecasting or NowCasting? And with that, we will wait a few seconds to collect your answers. All right, and I think this answer makes a lot of sense. Most of the firms rely on forecasting. NowCasting may be used more among high-frequency firms because they need to react very quickly to changing market conditions. So I think this result is very representative of what one could expect from the financial sector. Thank you very much for participating in the poll. Let's go now to the second lesson related to COVID-19. So the second lesson has to do with theories versus trading rules. It is common among practitioners and academics to run a large number of historical backtests in order to identify an investment strategy. So suppose, for instance, that we're trying to identify what days of the month are better for being long or short stocks. Well, we could run many different combinations with the different stop outs and profit taking limits, and very likely there will be one that will look great, like you can see here on this plot on the right. Now, this is to be expected. When we run hundreds of different backtests, it is almost assured that there will be a false positive. Why? Because we assume a false positive rate of 5%. After a few backtests, the probability of a false positive is essentially 100%. This is something that is very visible among papers published in financial journals, even in the top financial journals, where authors do not disclose the number of trials involved in a discovery. And the second caveat related to backtesting is that backtesting is not really research. In scientific applications, the purpose of testing is not to produce a hypothesis. The purpose of testing is to refute the hypothesis. So think, for instance, when Einstein came up with his theory of relativity, he didn't pick the tests that would be executed to evaluate whether the predictions of the theory were right or wrong. Independent teams came up with the design and execution of those tests. And even to this day, the theory of relativity continues to be tested in ways that Einstein could not have thought about. This is not the case in finance. In finance, we typically see this sort of circular argument where a researcher backtests thousands of trading rules, not theories, trading rules. Then the best performing trading rule is presented in an academic paper, and perhaps some story to justify why a particular trading rule has been used. And then the researcher uses the same backtest that was used to produce the hypothesis to test the hypothesis. So this, of course, leads to backtest overfitting. The main conclusion here is that not only backtesting is being misused in finance, it is a futile exercise. We know that for sure. If we try many different rules, one of them will just look like profitable, but it won't. It won't deliver profits out of sample. What can we do instead? What we could do is, instead of focusing on developing trading rules, we could try to focus on developing theories. What does this mean? What this means is that rather than coming up with a trading rule, buy on Mondays and sell on Wednesdays, or buy in March and sell in June, instead of coming up with these sort of recipes, we need to understand what is the precise cause-effect mechanism that would justify that a market participant would make a systematic mistake. Market makers do this all the time. They analyze the fixed messages that come from the exchange, looking for patterns that are indicative of uninformed traders. And that's where they know that they can narrow the bid-ask spread. And they develop theories, in fact, microstructural theories, to justify this behavior and explain it. And that is why market makers were not caught during the COVID-19 sell-off, because they operated based on a theory, and they know what are the limits of the theory. They know when they should supersede the theory and not follow the theory. They understand the exceptions of the theory. So backtesting trading rules is useful to understand the economics of an investment strategy, to understand how profitable it may be, but it is not enough. We need to understand where the money comes from. Here we have, let's open up for a second poll related to backtesting. So, does your company have a backtesting platform that records all results for future audit? And the options are yes, we record all trials. No, we don't record all trials. And third, we don't have a backtesting platform. Interesting. So about a third of participants recall all trials. Another third, they don't recall trials. And finally, firms don't have backtesting platform. I think this is a more surprising result. I would expect that there would be fewer firms that record all trials. So if this result is correct, broad-based, it would be very welcome news. When you look at the state of academic research, the answer would be 99% of authors do not recall trials, and there is not a particular procedure that is well established for backtesting. So if this result is correct, that means that the industry is way ahead of academia, which would be fantastic. Let's go back to the presentation and discuss the third lesson. The third lesson is to try to move away from strategies that are supposed to work under all market regimes. So typically, firms and academics backtest investment strategies going back decades, sometimes even over 100 years, in an attempt to provide evidence that an investment strategy works. Well, of course, as we discussed before, backtesting is not research. It doesn't prove anything. The whole point of backtesting is to disprove, not to prove. And but why would an investment strategy work for 100 years? Markets are adaptive. There are changes in regulations, in trade patterns. There are changes in pandemics, as you can see. And also investors learn from mistakes. So why is it that some investors would not learn from mistakes, or why would the alpha associated with the strategy remain and survive for decades? Well, the most likely answer is that when a strategy appears to work consistently for a very long period of time, most likely this is a false positive, especially if we have not control for the trials and we have not discounted the effect of selection bias. As you can see here in this plot on the right, today we live in an environment of zero interest rates. So if we have essentially zero interest rates in the US, in Japan, in the European Union, the history is not very relevant. This is a very key variable that involves how lending occurs, how financing occurs, and that puts into question to what extent history is helpful in order to evaluate investment strategies. What is it that we could do instead? Instead, what it could do is we could define different market regimes. Based on these market regimes, we could develop investment strategies that are optimal for a specific market regime. So for instance, we could develop an investment strategy that is particularly good at zero rate regimes, or high volatility regimes, or regimes associated with stagflation, regimes associated with increased productivity, or large unemployment. We can develop investment strategies associated with individual market regimes, and then we can use NowCasting to determine in what market regime we are and deploy a basket of strategies that are supposed to perform well under those regimes. In fact, we don't need to select a particular regime. We will have a distribution of probability covering multiple regimes, and therefore we would deploy an ensemble of investment strategies. Not one investment strategy, but an ensemble of them. What you can see here in this plot is how market makers, in fact, decide what liquidity provision algorithms they deploy on a particular day. So based on their estimates of the half-life of mean reversion and tail risk, they determine what is the combination of profit-taking stop loss that they will use when they provide liquidity in the market. And they adjust instantly. Every day they deploy a different strategy, essentially, based on the conditions that they observe in real time. Another application of this notion of regime-specific investment strategies is to use knowledge graphs. So what this means is a knowledge graph describes how various companies are connected. And the connection may be in terms of business ties, supply chain, competitors, share ownership, similar products, that they belong to the same industrial sector, etc. For instance, one simple example of a knowledge graph is the MACI 4-level classification, the GICS classification. Knowledge graphs are interesting because they encode forward-looking information. They are telling us this classification is not so much about the past, it's about the present and the future. When two companies in the graph merge, the graph will be adjusted instantly. When the new company joins the universe, the information is added, and the classification, of course, based on an economic analysis and a theoretical analysis that justifies that classification. So in that sense, knowledge graphs are forward-looking. We can adjust them, we can manipulate them based on how the economic situation changes. We don't need to wait 5 years until we have collected enough information of the chain, and therefore the empirical correlation matrix incorporates the new information. The new information can be injected instantly. And we can use the information from knowledge graphs to derive theory-implied correlation matrix. What does this mean? Well, it's outlined here in this plot. Correlation matrix, which, as you can see here, is very noisy, and you can see these sort of blocks. But again, with a lot of noise, there are many examples here of discontinuities, and the result is a forward-looking correlation matrix that uses the historical information on a structure that is imposed by the theory. As you can see, the covariance matrix that results from this exercise is much more continuous. It is less noisy. It will lead to more robust results. So, for instance, when you estimate the efficient frontier utilizing this correlation matrix, the weights will be much more stable because the covariance matrix will be much more invertible. The conclusion here is that rather than relying entirely on historical data for making predictions, we can use NowCasting to making better predictions that are more robust, and that where we understand what are the assumptions, right? Because we have injected this information into the models. Therefore, we understand what are the assumptions. The assumptions of these models are explicitly stated, as opposed to just using historical data where the assumptions are implicitly stated. And with that, let's bring up the third poll. Do your researchers develop all regime strategies or regime-specific strategies? And the options are all regime strategies, for instance, factor investing strategies, or option B, regime-specific strategies, knowledge graph-based strategies. Knowledge graph-based strategies being an example of a regime-specific strategy. There are different examples. Very good. I think this result makes a lot of sense too. about 3/4 of the responders say that they develop all regime strategies. This is very common among practitioners, and definitely it is, in fact, I would say almost 100% of what we observe in academic journals, and about a bit more than a quarter they develop regime-based strategies, which, for instance, would include market makers. If you are interested in these topics, I recommend that you read this book, Advances in Financial Machine Learning, or you visit this website, quantresearch.org, where you can find many academic papers downloadable for free that discuss these topics. And with that, let's open the floor for questions.
I'm going to chime in here. Thank you so much, Marcos, for this great presentation. And as we take the time to collect your questions, I've seen some of